Welcome to AI Snacks with Romy and Robbie, an AI literacy podcast translating AI and robotic technologies from difficult to easy to understand. I'm your host, Anastassia, founder and CEO of AI Edutainment, a company based in Switzerland. And together with me in this studio is Afshin Mashrefi, and he's founder of TradeWave. And Afshin wrote a fabulous book, The 100-Year Pattern. His data-driven approach redefined how both professionals and everyday investors uncover market opportunity, and we are exploring the rapidly changing world of trading through the lens of artificial intelligence. Afshin, welcome to this podcast. I'm absolutely thrilled to have you. And for the record, for our audience, I've already interviewed you for my Leading Through Disruption series.
Well, thank you for having me.
And I would love to dive in with a personal question. How did your journey from studying physics and working in medical companies lead to learning AI and ultimately creating TradeWave for financial analytics and data-driven tradings?
Oh, that's a very interesting history that I have. So I have not been a finance major. I was not working for trading companies or anything. I have been a technologist for many, many years, and I have worked initially in medical companies and then many years in telecom. And just through circumstance, TradeWave was created. So I have been a trader for many, many years. It's pretty much hobby. I'm a retail trader, somebody whenever I got a chance. I did some trading. I really like short-term option trading. I like math, and options is pure math, and that was very enjoyable to me. What happened was that I was recruited to a startup, and that was an illegal industry. And they had raised a couple of $1 million, and I was recruited to manage the software development. I did my job. It was done, and the platform is actually running for them right now. However, they stopped being able to raise money. They couldn't raise any more money. I was asked to wait home until money comes in. So I had to entertain myself, and I had this idea of seasonal analytics, and I had become a data scientist and AI expert through my recent. So I was just playing around with this, and I went into doing analysis on 1 trillion data points because now I could. I had the power, the computing power, and I had the knowledge to do it. And I did a very rudimentary seasonal analytics platform just for fun while waiting for money to be raised until a few months later I was told that they just can't raise money. And suddenly I'm out of a job, but I have a platform that I created. So I decided to move forward and make that a product. It turned out better than I expected.
And how did your background in physics and statistics help you to learn AI?
That's a great question. Many people might not know this, but physics is extremely statistically driven. If you go into very advanced physics, they actually call it statistical physics. It's all about statistics. And I studied solid-state physics, which is the science of building integrated circuits, which is purely, your computer, the chips are designed with a process which is purely statistical physics based. So I know statistics really well. I feel comfortable. My mind literally automatically works in the world of statistics. When AI suddenly popped into my world in around 2010 or so, and I just loved it because AI is purely statistics. It might not seem it, but as you learn more about it, you realize it's all about statistics. And that's really how my world of physics and statistics and AI has dictated my direction in knowledge and science. I am fortunate to be alive to see the advancement of AI. I didn't think anything like this could happen for another 20, 30, 40 years. But my God, it did. It's been such an amazing journey to see this advancement and understand it.
And how would you define your seasonality hypothesis for someone who is not accustomed to trade, who might not have a great knowledge about stocks, options, and all those financial tools?
Another great question. Well, what happens is that people learn to do trading and you need an edge. You need to have a knowledge of, otherwise, I know there was a time that they were doing experiments by throwing a dart at a newspaper and picking the stock there, buying it and seeing if they make money. Well, that is a random pick. And depending on the time of the year,
Were throwing rings on some sticks which represented stocks, and they did not
right.
perform worse than human traders.
Exactly. Majority of when people think that they have insights, like they use out of the blue, they take let's talk about a simple one, a moving average crossover, which is usually the first thing they teach in technical analysis. And the moment the first person that see it, including myself, when I saw it, I'm like, oh my God, I found the edge. And you think you found the edge. And then when you do back testing, you realize, oh no, you didn't. You could do a curve fitting, which means find that moving averages that'll work in the past, which is guaranteed not to work in the future. And it's really random. I mean, majority of what you see in technical analysis is just smoke and mirrors. Fundamental analysis is a different story. Fundamental analysis is truly allows you to go and analyze the health of a company. However, health of a company and price of that stock, for example, is connected with a really long rubber band. It doesn't mean that if today you realize this company is really healthy, that doesn't mean the stock's going to go up tomorrow. It doesn't. However, in the long run, it will. And this is the basics of Warren Buffett's strategy. He found healthy companies and held that company for the long term. But technical analysis, it doesn't, it's random. It's really the same as throwing a dart, something. But seasonal analysis is completely a different story. It finds times when behavior of its security has been consistent. And it's something everyone's heard of. They might not even know, but people have heard. If you're into stocks, you've heard Santa Claus rally. You might have heard about January effect. You might have heard about sell in May and go away. Those are all seasonal analytics cliches. People that say those don't even know what that means or where that information came from. However, there are some very interesting points to those. Those are correct. I have analyzed them. It does give you insights if you buy 2 weeks before Christmas, for example. You can measure these and actually find true ways of timing the market. Something every professional says, don't ever try to time the market. Yeah, if you don't have a tool to realize how to time the market, absolutely don't time the market. It's impossible to find out what's going to happen to stock unless you have an insight that gives you that ability. And TradeWave is basically, I don't think there's anything but TradeWave that gives you that. I'm not trying to advertise TradeWave. I'm trying to say seasonal analytics is the science of finding timing.
And your book is called 100-year cycles. Why
Pattern.
100 pattern? What is this pattern of 100 years?
Great question. Well, the broader markets are, for example, S&P 500 or Dow Jones index. This is how you can analyze what the big picture is. My platform has 97 years of S&P 500 index data. which is nearly 100 years. So I have analyzed that, and it's really, really difficult to find patterns inside of such a long period of time. However, I have found them, and they are so distinct and they are so powerful that I decided to call the book The 100-Year Pattern because of a few patterns that I've discovered, which is in the book, in there. The most amazing one in the 100-year pattern, which I personally call this 100-year pattern, is that I have found a 295-day period that occurs every 4 years. And it happens on P plus 2 years, which is 2 years after presidential election, United States presidential election. It starts on September 27th and it ends on the following year, July 18th. This pattern, this period, which is really 21% of all trading days of last 97 years, has captured almost 70% of the entire gain of S&P 500 cumulative gain in the last 97 years. I call that the 100-year pattern, so I rounded it 97 to 100. But that has never been documented anywhere until trade. Nobody's ever but I know they have discovered this. They just haven't publicized it because it's so powerful. If you look at TradeWave and you look at this, what I call 100-year pattern, you see that it has never gone down during this period. During wars, during recessions, depression. Actually, 1930 was the last time this period went down. So the beginning of the depression, it went down, and it has never gone down since for 97 years. Really, really an amazing period. And the reason I say that every institution knows this is because if you look at it, you see that they are buying incredible amounts of stocks when they are in this period. They would not buy this if they didn't have this insight.
I am very curious about how did you discover that? So you had your database. So I would
Yes.
ask you, how did you build this database? You are obviously a very advanced mathematician. You understand statistical patterns, and then you learned AI and you became a data scientist. So could you dissect it for us? What was this piece of building the database? What was the piece of your hypothesis building and then testing it in a model? And what were those aha moments which you wouldn't have had without AI?
Well, AI directly in what I've done so far, as you probably know from my previous, I do not use AI to find opportunities. There are a lot of people out there advertising stock market. We have this AI stock. It's pure garbage. Let's put it this way. If someone, which I know there are a lot of people that have come up with a way for AI directly to go and come up with trading signals, they would not be publicizing that because that automation value, the value would be in hundreds of millions of dollars and it would be run by gigantic companies. And the reason I say that AI doesn't just find it, because you got to tell AI what correlates to a winning and losing opportunity. AI doesn't know that correlation unless you teach it. That correlation itself is not something that AI can discover by itself. But I use AI in a different way. On TradeWave, I use data science in order to find the patterns, and then I use AI to take the historical probability and calibrate it and make the probability closer to what's going to happen this year. So this is how I use AI here. But AI itself, I mean, I can't tell you how much power of AI I have used, because I literally use AI constantly all day, every day. And there are many other features of AI that's going to be added to TradeWave coming in the future. But going back to your original question, that how did I discover this? Is that so TradeWave is a research platform. It's not a trading strategy. It's not something that's going to make you a billionaire by tomorrow afternoon. It's not that. It just gives you a different level of insight. So if you use TradeWave and look at the patterns that may or may not be immediately obvious and take a look at it, you can discover things like I did, like the 100-year pattern I mentioned. I actually hadn't discovered the 100-year pattern until I started doing research for the book itself. And as I'm doing research, it was kind of an accidental to find that period. I had looked at presidential election cycle. I can tell you presidential election year was usually bullish. P plus 1 year, which we are in right now, becomes very bullish after April 7th until end of the year. So right now we're actually starting a very big bullish surge starting Monday, this coming Monday for rest of the year. P plus 2 years is a terrible year. The first 6 months is usually very volatile to down. Even NVIDIA goes down in P plus 2 years. So I'm looking at all this, and usually from beginning to end of the year, worst year in the cycle is P plus 2 next year. So and P plus 3 the following year is extremely bullish. So I'm looking at this very bearish, very bullish, 1 year next to each other. And that's how I found out somewhere in the middle of this is the most bullish period of time in the last 100 years. And that's where the 100-year pattern was. Actually, I literally stopped doing everything for like almost 3 or 4 days because I couldn't believe this. I actually had to go back in the code to see if there's a mistake because this looked just too incredible. And there was no mistake. I actually ran analysis saying that maybe there is an error in the code. Nothing can be this bullish for this long, but there is. And no, the code was as rock solid as I hoped it was. So it was an accident.
But please, I know that you started looking into seasonality a couple of years ago. So you were fascinated with this seasonality hypothesis because probably your assumption was this is something which is kind of to be touched. It's tangible. And then you build upon it. So you evolved around something which seemed to be, let's say, valid and healthy from the beginning. So how many years did it take to come from the initiation to what you have now? And I have another question. My audience is not technical, so most of people listening to this very podcast, they would love to learn about AI. They would love to learn about industries where AI is being applied. They don't necessarily distinguish between AI and data science. And for you, those two seem to be very different. Could you please elaborate on that? And then please explain this thing around seasonality as an initial hypothesis and how did you come to what you have today?
Sure. That's another great question. What's the difference of AI and data science? Let's put it this way. AI would not be AI that you see without data science. The data that you put into AI to train AI. So for example, when you go into ChatGPT and you ask a question and it answers, that's because there is a model that's been trained with hundreds of billions of gigabytes of data over many, many months. And actually training one of those cost between $5 and $10 million of just computing power, rental, not even buying something. And over a period of time to make ChatGPT that you see today would cost hundreds of millions of dollars of just computing power to train to get to this point. The data that goes in, you can't just go and take a book and the text of the book and use that as training data. You have to manipulate it and change it in various forms. And changing that data has to be done by something called data science. So you use data science in order to prepare data for the output, for the training. Then AI gives you an output, and that output is illegible. You cannot tell what that is. You have to use data science in order to take this massive amount of data and make it something that make sense. So AI and data science go hand in hand. You can do data science without AI, but you can't do AI without data science.
I think this is a great explanation. How do you formulate your hypothesis? For this, you require data scientists and great ones. Now, if we go to seasonality, so how did the first spark come? And how did you bridge between the first hypothesis and kind of, yes, this is tangible to what you have today?
So in the late 90s, when I was just dabbling around, or it was early 2000s or late 90s, I was dabbling into stock market. I came across a book by someone named Jake Bernstein. I bought that book, and that book was a table of securities. Actually, it was futures that they were showing, and then it had a buy date and sell date, and then average return. That's all it was. It was tables. And I'm looking at this. I'm like, wow, this is fascinating. They have found these date ranges that certain futures tend to go up during this period or down. And that's the first time I got exposed to the concept of seasonality. A couple of years later, I tried to make my own seasonal analysis with a spreadsheet. I could do it just for a handful of stocks and a handful of years. I remember I did it on Dell for 5 and 8 years on a spreadsheet. It was not very helpful, but it was enough to give some insights of, wow, it does have recurring patterns in it. But it was so difficult to do when it was such a slow computers in the early 2000s compared to now. I was using Excel, which made it even slower. And I just realized this is just not something I can do. So I kind of abandoned it. So I dabbled in it then. And then I went to every other possible way. I did day trading. I became an expert in a very famous platform across day traders and automated trading called Ninja Trader. I used that. I did a lot of back testing. It was, every trading strategy there is, technical analysis. I know quite a bit about fundamentals. I tried it all. I could not come up with any consistent way of making money. And God, I know why now. It worked really well sometimes, and it just would suddenly just fall apart for an entire year. And then it worked well again. Well, I can't do that. Psychologically, I would be destroyed if I lose constantly for an entire year. So I kind of abandoned that too. I learned Elliott wave. That's the worst of all. I have a lot to say about Elliott wave. I'm an expert in it, and it's the most useless strategy I've ever seen anybody come up with. So all of those went away, but I always had this seasonality on the back of my mind. And because of the circumstance at the time that I mentioned, suddenly I had time, and I decided to entertain myself by actually using my new AI and data science knowledge to build something that was in my mind for 20 years. I mean, I never forgot about it.
This is a fascinating story. So you were spot on your hypothesis, and this is why it worked out with such a success today. And whenever I look into companies which are not big tech like Amazon or Meta, and they deploy AI successfully, the best of them would have 50% of hypothesis right when they start modeling, only 50. And then they learn on the go. So how was it in the case of TradeWave? Was it so well prepared that it could really proliferate quickly? Or what was the story there?
Well, the concept is scientifically sound before I started. I know if there are patterns that repeat in the market. And by patterns, I mean a certain date range every year or in a specific intervals that repeat. If they are there, I can find it. That's not a hypothesis. That's a fact. If it's there, data science can find it. If it's not there, data science says it's not there. So I knew that. Well, finding those was next to impossible in the old days without massive computing power. which is now is available to everyone. But even with massive computing power, it wasn't enough. You have to know how to get those. So that itself, I didn't have a doubt. The part that you're mentioning about AI is using AI into calibration of probabilities is something that I wasn't sure about. So that's something that I've experimented and I'm still working on making it better. But as for example, now LLMs can do web search on API level, and those web searches allow the probability calibrations to become more and more accurate. So for example, if TradeWave says, based on last 10 years, NVIDIA goes up or Tesla goes up during summer or month of July, for example, and then so that gives 100% probability. Historical probability, 100%. LLM-based APIs go and search the web, get certain inputs from the internet that tell you what's happening in Tesla today. Take those variables and recalculate what's the chance of Tesla to go up, because in the first 10 years, the information was maybe very positive out there. Maybe analysts had very positive views and so on. And then suddenly this year, that information has changed. Analysts are less enthusiastic about it because there is the short sellers are too many now. That changes that probability from 100% down to maybe 80%. That's how it would. That's how AI would calibrate the historical probability based on more recent data. But when you have that exact probability, for people that are very mathematically oriented, when you know the probability of a certain occurrence, you can, not occurrence, almost like a bet, you can calculate what's the optimum amount of money to invest in that. You can look at it. There's a very famous mathematical formula called the Kelly formula. It's based on probabilities, which those professional card counters use. Kelly formulas in order to decide how much to bet. Professional card counters, by the way, are not gamblers. They are playing statistics.
Yeah.
And Kelly formula is also used quite a bit in finance now.
As a former insurance underwriter, I understand the differences between possibilities and probabilities. But a common speaker of a language doesn't have in front of his or her mental eye this difference. But I would love to ask you one question. So a lot of leaders in investment industry claim that many traders over-rely on automation and AI. So what is this fine balance in your eye in between of human excellence in trading and what AI might contribute? And if you were out of sudden heading a large investment function in a fund, how would you advise young traders to work with AI and with automation?
The hardest thing to understand for people that are actually I advise or discuss this is that AI is not the final frontier. AI is a tool. You are the driver. You cannot make the AI be your driver. You have to know what it is that you want to accomplish and then use AI in order to do what it is that you want to do. It's a tool. Most people don't see it. They go and talk to ChatGPT mobile and say, oh, I think I'm talking to an intelligent human being. And they are like, if it gives an advice, they think that's the final advice. And it's not. It's a tool. So you have to be relying on your knowledge. You have to think a lot bigger than before. But remember, you don't have to do the hard work as long as you know what it is that you want to accomplish. So for example, the way I use AI. I use AI to calibrate probabilities. Imagine this. If I could do the same thing, personally, I may go and use about 100 data sources, get all the information, put it on a spreadsheet, come up with these formulas and come up with a way to calibrate the probabilities manually. That would take me a month to do for one stock, while AI can do the same thing for me in 3 minutes or less. That's how I look at AI. I look at AI as a team of very capable workers that go and do the grunt work, something that I always wanted to, but I just don't have the manual ability to do it. And then I unleash this team of AI. And if anybody, I know you are well familiar with it, but if you like AI, you want to go and learn about agentic AI. My God, that opens more doors than anything I've seen in the last year. That literally is now, I used to have one person that used to go and do work for me. Now I have a team of AI agents that go and do this work for me. And they communicate with each other. It's fascinating what you can accomplish, but that's my biggest advice. Never forget AI is it, and it's
which means you still need really to invest time in learning the trade and the subject.
exactly. But remember, imagine if you have a team of 100 people that are standing there waiting for your order. What would you be able to accomplish? Think about it that way. If you can figure out what you can accomplish with that, you have that team in AI.
Afshin, I would like to ask you my last question. Are we currently in an AI bubble? What do you think?
AI bubble? It's like the most obvious thing I have ever seen. But yes, we are in an AI bubble, and I don't see the end of it yet. I don't see the AI bubble bursting yet. There are so many places that still need AI to penetrate in our daily lives that I don't see the AI bubble done yet. I mean, I could be wrong, but there's so much. But I tell the story, I tell my kids all the time, you have to know everything you can about AI. They're not very interested, but I've forced them. So now they are learning and using AI more and more, telling you, you're not going to lose your job to AI. You're going to lose your job to somebody who uses AI really well.
I think that was a fantastic way to close this episode. I am tremendously grateful for your time. In the show notes, we will post all the information on the 100-year pattern, your book, which for me was kind of a study of economical history of the United States. I really learned a lot, and I see a lot of doors and windows opening into all kind of the directions to do better research and better understand the economics in general. And I think this is quite a tale that you top up your expertise with data science and AI, and it enhanced what you've already known. And it was a helper instead of something scary and something mysterious. Thank you so much for your expertise. And that was another episode of AI Snacks with Rom and Robbie. We discussed AI in financial trading and in discovering patterns in trading options and stocks. I will see you next week, and all the best to all my listeners. Thank you.